Do you ever feel like you're on a roller coaster in the stock market? You're not alone, and we're going to look at a really interesting chart in this episode of the Atlas Annuity Podcast. Hi, everyone. My name is Marty Becker. I'm the owner and founder of Atlas Financial Strategies in St. Louis, Missouri, where we specialize in safe money retirement strategies. Welcome to episode number 80 of the Atlas Annuity Podcast. I came across a really interesting chart from Stansberry Research that shows the roller coaster of emotions that people go through who manage their own stocks or do some type of day trading. And I'm sure if you've ever bought stocks on your own, you can relate to this chart. And it's interesting because it really happens when people start to notice that the market is going up. So at first, most people will notice a trend and say, oh, I got to keep my eye on this. And oh, if I wait any longer, I'm not going to profit. So I'm going to buy in now. And then it goes up a little bit more. And you're thinking, thankfully, I didn't wait any longer to buy. Then we start to go into a correction. And again, this could be the market overall or individual stocks. So you think, I'm going to use this correction to increase my position. I'm going to buy more. And then it goes down even more. And you're thinking, again, I'm going to double my position because I'm getting a deal. Buy. Then it keeps going down, and you're thinking, I can't believe it. The price is cut in half now. This has to be the absolute bottom. And then it keeps going down, and you finally say to yourself, enough is enough. I need to sell this thing, and I'm never buying another stock again, ever. Sold. And then it goes down a little bit more, and you feel pretty good about your decision, thinking, oh, luckily, I didn't stick in this thing too much longer. And this is very, very real. I see this all the time. Then it starts to get a little bump, and you're justifying selling at a loss that, oh, it's going to fall again. And it does. But then eventually it turns around and it keeps going up. And you're looking at it and you're wondering, what the hell is going on here? And then you're justifying again, like, oh, I knew this thing would recover. And then it gets basically back up to the same point that you bought it originally. And you're thinking, this time I'm going to buy it and I'm going to hold it. So this totally goes against what everybody is taught and what everybody says that they actually do, buying low and selling high. Unfortunately, we're always seeing people that are buying high and selling low. And I'll never forget my brother-in-law, who's very successful, always told me, Marty, the money is always made at the buy. But very few people actually do that. Very few people actually buy low and sell high. And there's a number of reasons that are well studied and well documented. One of them being overconfidence, meaning we all believe that we can control more than we can actually control. And I think that's in every area of our lives, to be honest. The other one is loss aversion. Some people would rather not lose $1,000 versus the chance of making $2,000. Then there's this other thing called the gambler's fallacy, meaning people believe that there's patterns that are very common in either investing and or gambling, which are closely related, and that you believe you can crack that pattern, or at least someone else can. And that's when you're seeing people paying money for these very expensive investment advisory subscriptions, which some of them are better than others, or you're listening to CNBC and Jim Cramer screaming about buying a certain stock. And I hate to tell you that 9.9 times out of 10, by the time the little guy hears about it, you or I hear about these super good stocks that are going to be a 10 bagger, the money has already been made. With very few exceptions, like the NVIDIAs out there, very few exceptions. The money's already been made by the time you hear Jim Cramer talking about it on CNBC. And the saddest thing about this is that we all know about these behaviors and that they exist and that they're detrimental to our long-term success and well-being. And even the professionals in the financial industry know these exist. However, an author and a very well renowned behavioral financial expert by the name of Daniel Crosby wrote in his book, The Laws of Wealth, He found that even the financial managers, the professionals, the experts, they're very good at managing the cognitive biases of their clients. But what he found when it comes to managing their own money, they were doing the exact same thing that chart shows. They're on the emotional roller coaster too when it's their money. So if the experts cannot manage their emotions when it comes to their own money, then what is the average person who doesn't understand this stuff at all? What are they supposed to do, especially in retirement when they have a pile of money and they're trying to make that pile of money last for the rest of their lives? You probably need to get off the roller coaster. And we've probably all been on one of those giant roller coasters where there's people puking in their lap and the things are whipping around the corners and your head slamming against those big shoulder harnesses. You need to get off that thing. Now, I'm not saying you should get totally out of the market. And again, this is not investment advice. This is educational purposes only. But I'm trying to make an overall point here. You don't want to be totally out because the best long term solution for inflation and net worth increases is going to be stocks. But my gosh, how long do you want to be whipped around on that roller coaster? And again, it's not investment advice, educational purposes only. But what is going to be the best solution? We know we can't get off it completely, but we can't stay on this thing for the rest of our lives either. Maybe you can get on like one of those kiddie roller coasters. It goes a lot slower and you can diversify yourself out of those sharp turns and the ups and downs by using like a 60-40 type portfolio. And that definitely is an option. But at the same time, you have to realize you're not getting ahead. And I understand there's all kinds of different withdrawal strategies for your retirement that may or may not work. A lot of it has to do with sequence of returns, depending if you're barely making it or if you're coming out way ahead. But let's just take a 30,000-foot view of a 65-year-old couple with $1 million, and they're going to start taking a 4% withdrawal with a 3% increase every year. Okay, so this is a very static calculation, meaning the withdrawal rate never changes. It goes up 3% every single year. Now, over the past 25 years, if this couple would have used a 60-40 portfolio, paying a 1.5% management fee, which is very common between the advisor fee and the fund fees, at least 1.5%, that same couple would have about $25,000 left in their early 90s. Okay, so that's not great. But let's say the same couple looked at getting a guaranteed income to cover that $40,000 they wanted or needed in addition to their Social Security, maybe any pensions, real estate income, things like that. At the time of this recording, that 65-year-old couple could have guaranteed a $40,000 a year lifetime income for around $563,000. If they took the remaining $437,000 and just left it in the 60-40 portfolio, at the end of the past 25 years, in their early 90s, they would have almost $600,000 left inside the portfolio. That's a dramatic difference from just using the old 4% withdrawal rule, using the exact same returns in a 60-40 portfolio over a 25-year period. About $600,000 difference in their early 90s. And they did it with a lot more safety and without having to worry about the ups and downs of the market, the economy, who's president, who's in Congress, what's happening in China, none of that stuff. Maybe you like the thrill of the roller coaster. And at the end of the day, it's your money. And if you want to be all in the market, that's your business. And I can think of maybe 5 clients out of the hundreds, if not thousands of people that I've talked with over the past 10 years that had all their money in the market, but they also had lots of other income sources. But if you like that thrill and you love the ups and downs, we're going to go back to a negative sequence of returns. If that same person, that 65-year-old couple, retired in the year 2000, took out the exact same withdrawals, so 40,000 their first year in retirement with a 3% inflation, that couple would have been out of money within 18 years of their retirement. And again, this is in the most recent worst case scenario. But what if they would have done what that other couple did with the 60/40 portfolio and just guaranteed themselves a lifetime income using an income annuity and then took the remaining portfolio and left it in the S&P 500 with dividends? They would also have approximately $600,000 left in their portfolio in their early 90s. But if we're going to look at a worst case scenario, let's say, what if the market did really well? Let's go back and look at the returns starting in 1995, where the S&P 500 had 5 huge years in a row. Let's just say same scenario, only now we're getting the returns from 1995 on. 40,000 a year from the guaranteed income, and now we're taking the 3% inflation withdrawals just from the portfolio. We're not buying and selling. It's passive management. The money's going into an S&P 500 index fund and it's staying there. And even with these somewhat high fees, you can do cheaper in an index fund. This same couple using these returns in a positive sequence of return scenario has over $4 million left, or almost $4 million in their early 90s. This is a very different scenario from being all in on something. So it's not about just having everything locked up in fixed interest products. This is about getting off of the emotional roller coaster and having the safety to make sure you always have an income to cover your living expenses. Because worst case, even if you ran out of money, you would never run out of income. So everyone, I hope this helps. And if you're new to annuities, the best recommendation I can make to you is to go and watch my 5-part video series, 20% More Spendable Income in Retirement, which there should be a link in the show notes, or you can just go to atlasannuity.com and click on the video section. You'll find it in there. Once you have a chance to watch that video series, if you think the Atlas annuity strategy is a good fit for you and your retirement, then the next best step is to book a short Zoom call with me so we can get your questions answered and figure out if it is an appropriate fit. And you can also go to atlasannuity.com. That takes you directly to my calendar page, or you can click the schedule a call button in the top right corner of any page on my website. And if you're enjoying this information, do us a favor, subscribe to the podcast, follow the YouTube channel, give us a thumbs up, share the information with someone that you think could benefit from hearing it. And as always, I want to thank you for joining me. Again, my name is Marty Becker. This has been episode number 80 of the Atlas Annuity Podcast. We're wishing you all the best in your financial education. We'll catch you in the next episode.